Brace the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. We'll even give you a $100 credit on your next campaign. Get started today at linkedin.com/results. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
Hello, Don McDonald here with another daily edition of Talking Real Money, the podcast. Thanks for listening. We really do appreciate you. And remember, you can call in your questions about anything that has anything to do with money to 855-935-TALK, 855-935-8255, or you can send us your questions via our website, talkingrealmoney.com, where you can do all kinds of other cool stuff, including talk to one of our advisors without any cost or obligation whatsoever. You just go click on the set an advisor appointment and you'll set up an appointment. You can talk to one for nothing. Now, we won't manage your money for nothing for the rest of your life. You have to pay for that, but we sure do want to help you and everybody else out there. 855-935-TALK is our phone number. Give me a call. Love to talk with you on the show or the podcast today. Today, I want to talk about misleading headlines. Actually, I want to talk a little bit about the financial news media in general because they do things to make you read their stuff. They say things that are irresponsible to get you to read their stuff. And one of the most egregious financial websites out there when it comes to misleading headlines and just bad stories is MarketWatch, which is owned by Dow Jones, which publishes the Wall Street Journal and Barron's. MarketWatch, though, is like the yellow journalism division of Dow Jones. And today, what day is it? Thursday. I saw this headline this morning when I was looking at MarketWatch because I look at it. And the article was entitled, "If you're tracking the S&P 500 instead of this fund, you're leaving money on the table." I'm leaving money on the table. What have I been doing wrong? Well, first, let me just start by saying we don't think you should own just the S&P 500. That's a mistake. But we also don't suggest you do what this guy who wrote this article said you should do. He said, why don't you just buy the QQQ, the triple Q? The triple Q, you remember back in the 90s, everybody was touting the triple Qs. It's an Invesco, it's the symbol for an Invesco index or ETF that follows the NASDAQ. The NASDAQ 100, the biggest NASDAQ companies. And this was all the rage back in the 90s. In the late 90s, everybody was saying, why are you investing in that old-fashioned, dull, boring S&P 500 that, it didn't do well and it's not going to do well in the future, and when in fact it didn't. Why don't you buy the triple Qs? Buy the QQQ, which is this ETF. And even Susie Orman was saying, buy the triple Q. Great profit potential. It's tech stocks. How can we go wrong? Remember that? 90s tech stocks? How can you go wrong? Every idiot was buying tech stocks and making a lot of money, and you were going, oh, look at those idiots making a lot of money. Maybe I should go buy the triple Q. And then you did it in maybe late 1999 or early 2000. Do you remember what happened to the triple Q after that? It plunged. $100,000 in March of 2000 was worth less than $20,000 by September of 2001. You got killed. Now, does it have periods when it makes a lot of money? Absolutely. But what's the rule when it comes to investing? If it has the potential to make you lots of money, it's going to have higher levels of risk. The S&P 500's worst decline was about 50% ever. in a year. The triple Q, 80% in a little over a year. That's volatility that most people could not possibly stand. These are more risky securities. Of course, they're likely to make you more money at times. But how many of you have a stomach for an 80% loss? The volatility of the QQQ over the last 15 years, according to Morningstar, as measured by standard deviation. A standard deviation of 0% means no price fluctuation whatsoever. Well, the QQQ over the last 15 years, when it has beaten the S&P 500, is about 17%, while the S&P 500 is about 13.5%. That is substantially lower levels of volatility. And nowhere in this Market Watch article, nowhere does the author state, wow, these things are really risky, because he doesn't have to. He's not selling them. He's just writing. He can be as irresponsible as he wants to be, and he certainly is, by telling you to go out and buy the triple Q instead of the S&P 500. And again, as I said earlier, we don't believe that you should just buy any one index like the S&P 500 or the NASDAQ 100. We believe that you should diversify globally, and you should probably have some bonds in the portfolio to help reduce volatility. I just hate these articles that have these definitive answers. Well, you should have been doing this the whole time. Well, thanks for telling me after it's already gone up. Now tell me what it's going to do next. That they absolutely do not know. Let's go to the phones. 855-935-TALK is our phone number, 855-935-8255.
Hey there. My wife and I are looking to buy a home. We have a young child we're looking to upgrade. We own our condo. We have about $200,000 in liquidity. And what I'm looking to get some advice on is how much of a down payment we should put down on a home. I know in the past we've been pre-approved for a home up to $1 million, and we're sort of looking in that range. But there's been options in the $600,000 to $1 million range, and I want to be more conservative with how we use our liquidity. So I wanted to ask that question. And the second question we have is related to making a cash offer. There are a couple companies out there that will buy the home for you via cash, and then you do like a second closing with them to pay them back and take a mortgage out for the amount owing. So I want to get your thoughts on that. Thanks.
Well, buying a house. I hate mortgage insurance. I hate paying for it. It just adds to the cost of the loan. Now, it's not a big cost, so it's probably not something that should be of high concern to most people, but I would lean toward a 20% down payment, even though that depletes your liquidity. The best way to avoid depleting your liquidity is to live below your means. It's to buy a house that is below $600,000, so that you put less into it. You don't have to put. If you go to $1 million, you got to put the whole $200,000 in there to get to the 20% down payment to avoid the mortgage insurance. And to me, that's just kind of silly. You can certainly find houses. You may have to come in below where you'd really love being, but it's better to buy a little below your means than to exceed them and get yourself in trouble down the road and have those extra expenses. So that said, you use as much as you need to get to a 20% down payment. Try to avoid $1 million house. In other words, keep some liquidity. Now, as for the other deal, what? Somebody else is going to go buy a house for cash. This is starting to sound a little scammy. They're going to buy the house you want. They're going to give the sellers cash, and then they're going to sell the house back to you, and you take out a mortgage? Where is the benefit to you in that? I cannot imagine that they'll sell it back to you at the same price. There's got to be a catch. There always is a catch. And anytime you add a middle person to the transaction, you are going to pay for it. That's why I get really, really upset with real estate agents' commissions these days. As the house prices grow, the percentage commission should decline. It's like the investment advice business. When we're managing a small amount of money, we charge more. The more we manage, the less we charge, because selling $1 million house or a $2 million house is really no more difficult than selling a $500,000 house. And I have to talk in big numbers because, Seattle is one of the few places where you've got numbers this big. And don't you ever think that this is absolute sustainable growth, that these kind of numbers are going to repeat. Don't fall into that trap. It has hurt many people around the country many times. Just talk to folks in Phoenix who bought houses in the early 2000s, folks in Las Vegas, folks in Florida. They got killed in a real estate bubble. So live below your means, 20% down payment. Don't mess with any of these people offering some sort of a special deal where they'll buy your house for cash. They're going to get it. They're going to get a profit somewhere, and that somewhere is probably from you. So, no, don't do that. But thanks for the call. And you, all of you, please give me a call at 855-935-TALK, 855-935-8255. As you can see, we don't just talk about investing. We talk about anything money-oriented on Talking Real Money Daily. And while you may not like my answer, I'm going to tell you what I honestly believe, what I truly believe, based on almost 35 years of experience in the financial industry and on the radio doing financial talk. Give me a call anytime, 855-935-TALK. And if you need someone to talk with in a bit more detail, remember, we do offer absolutely free, non-sales pitchy meetings with our fiduciary, 100% fiduciary, fee-only advisors. We don't charge you for a meeting just to kind of wrap your head around what you need to be doing. Yes, we will charge you for managing your money, and if you want us to do that, we'd love to have you come aboard. Otherwise, we certainly invite you to go online to talkingrealmoney.com and click on the investor appointment button. They'll set up an appointment. I promise you they won't sell you anything. Absolutely promise it. Because we get clients without having to push anybody because we're honest. It's funny how that works. When you tell people the truth and you do what you said you were going to do, and one of the things we say we are going to do is not lie. You may not like the truth. A lot of people come to us and go, well, can you beat this return? And we go, no, we can't beat that return. That's not why you hire a money manager. I know you think that's why you hire someone and you expect that every single year you're going to get big returns. Well, you got a bunch of advisors who are just not competent to do business if they've failed to tell you that you will lose money at times, and who haven't tried to build a portfolio for your particular tolerance and, by the way, need for risk. Thanks so much for listening to this edition of Talking Real Money Daily. And remember, you can subscribe to the podcast at Apple Podcasts or iTunes or any of your favorite podcast services. And we really, really appreciate you being there. Talk to you again tomorrow. I'm Don McDonald.
Talking Real Money.
Need a little help with your money? Free advice awaits with a fiduciary fee-only advisor with no cost or obligation.
Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.